launching a token, creating the token is one thing, and creating a market for that digital assets is an entire different journey.
You have to be very clever in how you manage your treasury. We have huge volatility. You don't want to rug your own project and community.
You do the crypto way where you have a lot of hype, you basically build a very big brand, and then you start thinking about the product.
I see early projects accelerating much faster when they allocate a portion of, the revenue or a portion of the treasury.
Okay, let's start with just basic introduction from all the participants. Let's start there from Fernando.
Hello everyone, Fernando here, based out of Switzerland. I've been in digital assets since 2013 and also building since 2018 in the space of tokenization. Today we help asset managers tokenize some of the assets they trade, as well as create liquidity distribution strategies. Telegram, respectively Ton, pick one of our ventures among the leading finalists on the hackathon. And we see a very interesting market that I'm very happy to share with you today.
Thank you so much. Jan, should you proceed?
Hey guys, my name is Jan. I've been in crypto from 2011. I built two very well-known startups, but now I built one of the biggest M&A and secondary marketplace. We facilitate a lot of different secondaries, including equities, OTCs, safes, and on the M&A side, we represent both the buy and sell side. Happy to be on this panel.
Okay, and the word goes to Lee, Peak Events.
Great, thank you. It's a real pleasure to be here today. So I've been investing in building and scaling companies for 20 years. I've been doing it in the crypto industry since 2016, 2017. I run a company called MV Global. We are an investment firm. We've deployed close to 9 figures in about 300 companies. So we run an early stage venture fund. We also have a liquid strategy. And we've built a bunch of companies. So we have a number of operating companies across the value chain in our industry.
Thank you. We also have Nikhil Joshi from Emergo.
Thank you. So, good morning. My name is Nikhil Joshi. I work for a company called Emergo. We're a co-founding entity of Cardano, but essentially we're chain agnostic, and we position ourselves really to work within the finance space, be that working with traditional finance players or indeed in the more DeFi space. Our focus very much for this year is around private credit tokenization and also SAF trading, rendering it more liquid. We're headquartered in Singapore. We have about 65 people globally. But yeah, there you go.
Okay, thank you. So basically, our panel now is called Institutional Opportunities in Scaling Web3 Businesses. So the main topic would be exploring operational and financial factors and innovative frameworks that enable Web3 ventures to scale within traditional institutional environments. So guys, let's start with some baseline questions. The first is going to be, so what operational challenges must Web3 startups overcome to achieve an integration into established institutional, custodial, and compliance infrastructures? So let's start with Fernando.
I mean, we saw a few cases where some of the startups that went down had close to non-existent accounting systems and so forth. I mean, what I see from developers is that they claim many of these transactions are already recorded on blockchain, therefore it's redundant to have a system that essentially tracks all these transactions. Now, I feel for companies to scale, you want to have proper CFO operations, proper accounting and audit in order to assure all these money flows and treasuries are properly recorded. This is key. Second, when it comes to managing customer funds, respectively clients and so forth, you want to assure this is segregated and therefore this is in a way separated from the operations that you're handling, and also you want to create gateways in terms of accessing that sort of capital. That includes implementing ISO protocols for security, for opening, handling the wallets, as we saw with Bybit, as well as adding additional security protocols to that touch point.
Okay, thank you. Now the word goes to Jens Strandberg from Acquirify.
Yeah, I think the biggest problem is licensing at the moment, what we're seeing. We see a lot of players coming in, and basically they want to tokenize everything. But the problem is that depending on what jurisdiction you are in, you need different licenses. And overall, the governments are still a little bit lacking behind, so that's one. And I think second one is the banking rails, like integrating all of this into a legacy system. It just doesn't work yet. So on that front, I see a lot of new and up-and-coming companies that are solving this, but it's still something that, at least what we see as a problem here. But yeah. I think that's it.
Thank you, Jan. Lee Pickavans from MV Global.
Yeah, I mean, I'd echo the two comments already. And I think those are very sort of like the operational hurdle is actually very high in this space. But I think what a lot of these companies are going to forget is you need to make money. And so looking on the commercial side of the business to make sure they actually can stay and last in the space long enough to actually get to market is an even more important hurdle. And if they want to go and scale and become institutional level, you need to be in the market for a long time. You have to pass the test of time. Otherwise, there's no chance.
Okay, thank you so much. Nikhil Joshi, Emergo.
Yeah, thanks. So I think it's just the 3 C's. Custody, compliance, composability. I think institutions are not ready to self-custody. So the wallet infrastructure, the multi-sig, MPC, et cetera, that needs to be in place with the right custodian or custodians, plural, giving optionality. Compliance is just a thing, right? If you're dealing with institutions, they have to tick certain boxes, and so that has to be, it's a hygiene requirement, so it has to be done. And thirdly, composability. I think institutions don't care about chains, so it's all about chain abstraction. The underlying needs to, inverted commas, talk to each other, right? The tech stack needs to be able to talk to each other. The institutions are not going to be loyal to a particular layer 1 or 2. So it needs to be seamless from that point of view.
Thank you, guys. So the second question is, how can strategic partnerships with traditional asset managers, custodians, and compliance experts expedite enterprise-level adoption and distribution of Web3 products? Let's start again with Fernando Verbonen from Curie Invest.
So we were very early approaching institutional players. UBS Future of Finance select us among the leading Swiss finalists, and we saw that a main portion of the time was spent on education, on transferring some of these learnings from our tech division to them. Now, this has changed since then. We have collaborations with auditors, with accounting firms, as well as with asset managers. And we are decreasing the friction that basically enables those asset managers to do what they're good at, which is in this case perhaps trading gold, issuing bonds backed by Swiss mortgages, private debt, loans, and so forth, and using some of these capabilities, such as tokenization, in order to expand their distribution. It's very important that there is a strong or close dialogue with top management, so you have, in a way, a vision of the project from the start to the, let's say, finishing line. It is important that these relationships are supported by a tech CTO of the asset management firm. Asset managers do have CTOs. They are actually very strong in cybersecurity, so having a collaboration with them makes a lot of sense. And third, you want to create or prioritize the concept of building an ecosystem, because as I was sharing earlier to Lee, launching a token, creating the token is one thing, and creating a market for that digital assets is an entire different journey. So prioritizing ecosystems, collaborations, discussions across different stakeholders certainly improves communication, creates synergies, and most importantly, enables everyone to profit from it.
Okay, thanks for insight. I definitely never heard of CTOs in asset manager firms before. So yeah, thank you. The word goes to Jan Strandberg from Acquirify.
Yeah, I think it's more about the distribution. Like, we need legacy TradFi companies to come in this space. We need their liquidity. But at the same time, they need us to build stuff for them. So I see one thing there as a collaboration opportunity. But it's the same thing, like building a brand, you need very good players behind you. If you don't have them, you can't attract money. If you can't attract money, you can't get liquidity. And that's also like if you want to have a lot of customers or you want to have a big customer base, you still need legacy media. You need a lot of legacy companies to come in and work with us. But it's very hard, to be honest. But yeah, I think working side by side is a very good, what do you call it? Partnership that can build up a good growth, but at the same time also leverage revenue.
Thank you. Lee Pickavans, MV Global.
Yeah, I think there's great points. Brand, market reach, distribution channels. There's going to be an operational compliance stack from a large corporate partner, so you can go up the learning curve very quickly. A lot of companies try and structure a pilot program to get access to all of this. But I think the flip side of this is all those points are why large incumbents actually have a lot more market power to operate the space and beat all these sort of ambitious young Web3 companies. So I think looking at the market strategically and thinking through the path for your startup and where you think the exit's going to be, whether it's, we'll talk about tokens and issuing a token, whether it's an acquisition path. We see M&A activity increasing quite dramatically, which is a sign the industry's maturing. So looking at it more strategically and timing the partnership, I think, is quite critical today.
Okay, thank you. Nikhil Joshi, Emergo.
So I think it's been covered. It's essentially trust and distribution. I'm just going to go one layer below trust, which is that if you're working with traditional asset managers, they're going to come with a traditional customer base. And so all of that comes to sales lead time, sales pitch, and education. I think that means that taking products in a particular sequencing for that customer base to be ready for. So that may mean the distinction between digitized assets versus digital assets, right? So going out with, say, stable coins or yield-bearing stable coins or real-world asset tokenization is a set of steps that one needs to take before you can get to a structured product which is entirely made up of a series of different digital assets. So for me, the trust has to come through hand-holding. Certainly, traditional asset managers will bring trust and distribution. I'm just saying that I think it then needs, like, you need time for the underlying client to understand the product.
Okay, thank you so much. The third question would be, which customer acquisition strategies have been most effective in expanding tokenized asset offerings to institutional investors without compromising the underlying token economics? Okay, let's still go this way around. So let's start with Fernando Verbonen from Curio Invest.
Right, so, I mean, this is partially, business secret. This is, no. When it comes to business development and customer acquisition, you face reality, you face the market, you face challenges, you face and introducers' fees and so forth. What I've come to realize is that first, you are required to segment specific customer targets. You want to have enterprises, you want to have asset managers, you want to have entrepreneurs. And once you have nailed down those customer targets, then you need to understand what problem they're facing and what solution you can bring to them. Are they seeking to raise capital? Are they asset rich and are seeking to perhaps use their assets as a collateral? So forth. Are they looking to create a new business venture? Now, tokenization is just in a way the beginning of that, of solving that problem, but it essentially opens a new gateway. And so typically these clients don't have the experience to navigate across these new territories. So as a founder, I help them basically end-to-end to source, to leverage ecosystem partners, to leverage that journey and to essentially achieve the integration within their ecosystem. Now, in the past, what I've seen is many projects piloting and launching a token. However, as we mature in the market, we see protocols prioritizing collaborations as well as distributions and creating venues, whether it's panels, whether it's events, specific, institutional rich venues like in Singapore, in Dubai, in Zurich, and so forth, and using that as a platform. I would argue Token 2049 is exceptionally a great place to meet different institutions. Some of my shareholders are coming here. Some of my clients, these are asset managers tokenizing high volumes of assets, are actually meeting all here and attending some of these side events.
Okay, thank you. Jan Strandberg, Acquirify.
Yeah, I think one thing is to build your brand. If you can build trust and a brand that people really trust, you will bring a liquidity. Another thing that we builders in this space build is product market fits. If you don't have a product market fit, it's really hard to attract any real users. If you don't have any real users, it's really hard to then launch a token and basically get some volume on it. I think it's very simple. Get product market fit, get a brand that people trust, and you will have a token that people actually use.
Okay, thank you. Lee Piquant, MV Global.
I mean, I was basically going to talk about product market fit, so I agree.
Okay, thank you. Nikhil Joshi, Emergo.
I think there's a few things, but probably token utility focus. So if you don't want to script the tokenomics, make sure that your token has utility. Amongst a number of things, but I'd probably place that as number one.
Okay, thank you. The question number 4 is, how should Web3 companies strategically manage capital raises to sustain operational growth while maintaining token value and investor alignment? Let's go the other way around for a change. Let's start with Nikhil Joshi, Emergo.
So I think this is probably not unique to Web3 startups. I think it's probably just across the board. Raising milestones. I guess you can think about equity token hybrids. But again, I think to a point I made a second ago, what is the utility of your token? So I think people want access to tokens for the immediate liquidity. There's pros and cons to that. But are you looking for cash to fund yourself for the next 6 months? Or are you looking for a strategic partner? So then strategic investor selection kicks in as well. I don't think there's a points that are unique to Web3 necessarily. I think it's the same path that any startup should be following.
Thank you. Lee Piquant, MV Global.
Yeah, I think building on that, the biggest challenge I see and the biggest mistake I see companies making in the Web3 space is they rush to issue the token. And once you're managing a publicly listed token, the complexity and dynamic and the pressures that brings to your business when you're still at the very earliest stages is trying to scale and build, quite often businesses fall over. Now in our industry, many see that as the success, right? And we all know rug pulls and people pull out money. But if that's also a core pillar for building your treasury, which is going to give you your runway for the next 2 or 3 years, you have to be very clever in how you manage your treasury. We have huge volatility. you don't want to rug your own project and community. And so I want to see teams that have laser focus on the highest priority activities, know what they're building, understand capital efficiency and how they're deploying money into the business to get the biggest impact, so that when they are ready to issue their token, it's actually a scaling and a positive growth narrative rather than just adding complexity.
Okay, thank you. Jens Strandberg, AcquireFi.
So we facilitate a ton of secondaries, OTC, and so forth. We work with most of the foundation, and our number one question that we always ask them, like, what are you guys using this money for? And is this a strategic round or is this something else? And most of the answers is either you're launching a new product, or you're expanding the team, or you're reshuffling basically your old investors away and bringing new ones. And this is pretty normal, to be honest. So I think from our side, like, and what we've seen in the market is that it's either hires that are expending a lot, or OPEX is just rising and you just need to raise money because of that, or you are reshuffling basically your cap table and bringing new strategic partners. And I think this is totally normal. Like, if you have someone that wants to exit and you need capital, it's the easiest way to do. But yeah.
Yes, so optimizing treasury is never trivial. On the one hand, you have fixed costs. On the other hand, you know, some of the digital assets are fluctuating. We've seen the Bitcoin and others decreasing in value, sometimes minus 80%. So you want to actually diversify your treasury, and you want to have that, you know, strategically across, obviously, stable coins, fiat, you name it, but also other assets that provide perhaps some yield, some bonds, and so forth. Now, one of the challenges I've seen is that some teams effectively just park their capital into digital assets that fluctuate without considering the running way, and therefore, when, you know, volatility kicks in, they are paying the cost. So a good strategy for Web3 scalings is to assure you have already a runway in stable capital that doesn't fluctuate over the next 3 to 6 to 12 months. Also, if you have investors' capital, you want to park some of that also on money market funds or on yield solutions that provide PY that perhaps enable you to meet inflation. And last, you want to reserve a portion of your treasury for strategic collaborations. I see early projects accelerating much faster when they allocate a portion of, you know, the revenue or a portion of the treasury to those partners. So that creates essentially those synergies that enables you to launch faster their RWA project.
Okay, thank you, Fernando. So let's do also a couple of closing questions. So the first one would be, what is the most important time to market factors for projects to build, reach product market fit, and scale quickly? Let's start with Nikhil Joshi from Emergo.
So product, I think a narrow focus on product is important. And then finding a distribution channel. I think the perennial problem with sort of Web3 is it's a solution looking for a problem, right? That's the accusation, the criticism that's thrown around quite often. I think finding a product that solves for a problem and having a very narrow focus on that, and then solving for distribution is the solution here.
Thank you. Lee Pickevans, MV Global.
To focus on product, I think you have to be ruthless on knowing the product that you're building and the proof points that you need to solve for to get conviction to go to the next level. Too many early stage businesses think they have to do everything all at the same time, and so they misallocate capital, they hire teams too quickly, and all of that complexity ultimately ends up slowing down. So ruthless focus on product development, getting feedback loops as fast as you can to iterate through their product, get those proof points, then get to market and keep pushing your sales, right? Sales is proven, repeatable sales of your product gets you product market fit.
Thank you. Jan Strandberg, Acquirify.
So I think you have two ways of doing this. You can either go the way that these gentlemen are saying, that you have a product market fit and you build a product that actually works, or we do the crypto way where you have a lot of hype, you basically build a very big brand, and then you start thinking about the product. For me, I think the first one is the better, but obviously we are in crypto, and I see this more and more happening. Like, you guys all probably invested in meme coins. What's driving a meme coin is basically hype. So, I rest my case.
I like to think that there is a reward after hard work, and what I've seen is when you focus on the value that you provide to your end customer, and you shape that into a proposition, and you consistently ask yourself how that value comes across, what differentiates you, then that increasingly positions you within a niche. And this is why some clients, some asset managers that have conducted some operations, perhaps tokenization services, have returned back, in our case, to us and asked us to support them. So I believe certainly in this industry there's lots of marketing and so forth, but ultimately I've also seen many teams come and leave. So it's a matter of growing in a way organically and systematically that value proposition towards finding that product market fit that you mentioned earlier.
Okay, thank you. Now, before we finish our panel, we also have a few participant-specific questions. So let's start with Lee Piekewens from MV Global. So beyond providing capital, what are the ways VCs can assist projects on the building side moving towards market success?
So I think the primary function is provision of risk capital. But not all VCs are built the same. You can flip it around. If you're an entrepreneur, you want more than just capital, right? You want other value levers from the partners and the investors in your business to help you succeed. And so a broader value proposition, and every VC fund is different depending on their funding and what their management fees allow and how big they are. For us at MV Capital, we first want a alignment with the vision and ambition of the founding team and the founders. If we don't see the vision and the path to success, we can't follow that business. And I think we're unique because we have deep researchers, we have technologists, we have entrepreneurs, we have people that have built and scaled businesses, and we have traditional VC, TradFi finance skills. And so for us, we think, we de-risk the checks that we write by bringing this breadth of expertise and offer that to the teams that we work with. Now, our business is investing, so how we do that is more of the question, because we can't spend full-time energy doing that. So we like to have and structure very strong advisory relationships with all our portfolio companies. We're there to provide access to our network, resources, expertise, across the journey that startups go on. So we're there for the journey. We often participate in funding rounds. We often help with later stage funding rounds and make introductions to our VC network. We often help with HR networks where we can bring talent into the business. So there's a big multifaceted aspect to what VCs can offer. And obviously every VC fund is slightly different. But from the entrepreneur's perspective and the VC's perspective, it's all about reducing risk, right? How do I reduce risk for this business to make sure we get a success?
Okay, thank you so much, Lee. So the next question is specific for Jan Strandberg from Acquirify. So Acquirify is bringing M&A to the Web3 space. So what role do you see M&A playing at the moment in Web3 scaling strategies?
Yeah, so I think first of all, a lot of protocols, exchanges are realizing that actually building themselves something from scratch is very expensive. Also attracting customers can be very expensive. So what's happening now is that we're actually seeing more and more M&A activities. And if you look at last year and this year, we've seen so much more activity than before. One reason is that we are actually maturing now as a space, which is very good. We have founders finally coming to us and being like, hey, I've been building for 6 years and I have a possibility to now to exit. So first of all, like grants, they don't really work. Like if you want to buy customers right away, and especially like projects here that raised a bunch of money and haven't built anything yet, I think it's a very good acquisition strategy, both from tech side, acquire side, or even customer or revenue side. Like you can basically buy something out right away, maybe an exchange, maybe a launchpad, maybe a DeFi protocol, and you get right away TVL, you get customers, you get tech. You basically are jumping from level 1 to level 5 right away. And I think that's the beauty of M&A. And I'm very happy that we have actually come this far now. Like if I look when I started in 2011, I wish I would have an M&A platform. I wish I would have an opportunity to exit. But we are finally here, and I think projects here should really look at it more and more. And I think also someone in this panel.
Thank you. Next question goes to Nikhil Joshi from Emergo. What do you think is the biggest opportunity you see now in tokenization?
So we're seeing a lot. So Emergo specifically is pursuing a strategy around private credit tokenization. I think there's a bit of a fallacy that just because you tokenize something, it immediately brings liquidity. We don't think that's the case. Our hypothesis here is that actually it's more a case of going down a liquid stack where assets that are more liquid will benefit from tokenization first, but that doesn't include those that work well in the real world. So bonds, equities, these will be tokenized in the near term, primarily because they offer collateral in an otherwise, should we call it, crypto trade. But tokenizing for the sake of it doesn't automatically bring incremental value. For us, going to things like insurance premium financing or cash management products, that type of thing in the private credit space is where there is value to be brought from tokenizing, and there is demand for it. Over time, you go down that liquid stack and you'll end up with something like real estate. But tokenizing in of itself will not create automatically demand and access and distribution. Those are the 3 pain points that really need to be solved for. So we're working on that. But again, it's going to be a case of sequencing of going down what I'm referring to as a liquid stack, from more liquid to less liquid.
Okay, thank you so much. And the last question is to Fernando Verbonen from Curio Invest. So what role does treasury management and capital allocation play for projects building towards broad adoption?
Yes, so as adoption of tokenization increases, it is time for crypto institutions, foundations to diversify their treasury, to reconsider what should be there beyond Ethereum, beyond Bitcoin, and so forth, and to explore other ways to essentially diversify it by including RWAs, including private debt representing bonds or auto car leases, and therefore extracting yield from the real world.
Okay, thank you so much. Do we have a time for questions from the audience, or should we wrap this up? Okay, I think we should. Do we have questions? Do we have time for questions from audience, or that's it?
Does any of the audience have questions? Going once? Going twice? Seriously, with this roster, you're not going to take the opportunity to pitch your project and make it a question? We need some brighter founders here. Hey, how about you? Do you guys have questions for each other? Like that would be a great way to push this forward. Like, what are you doing later? Okay. Well, hey, look, I just want to thank everybody for being here. Let's give our panelists a round of applause.